Let us now start preparing our financial model, and first of all, let us discuss the scenario that we are going to use. Our client Jessica Smith is planning to start a business that is a stuffed toy company, and she has named it as Stuffed Smiles. Now, there are some basic things that we need to know, and these are: this business will be selling stuffed toys on Amazon in the USA, and the sourcing of toys will be done from China using Alibaba. So Alibaba is just like Amazon. This website is based in China, and suppliers from China provide you goods on wholesale to sell somewhere else. This is a very common business model currently being used. And after buying from Alibaba in China, we will be selling those products on Amazon in the USA. Our first year of business is going to be 2023, and our financial year end will be 31st December, which means that our year will be, for the reporting purposes, our financial year will be starting from the 1st of January and it will be ending at the 31st of December. And the last thing that we should know is today's date. Please assume that today's date is 30th of September 2021. We are doing all the workings on this specific date. Now, after consulting with Jessica, we have compiled together some information about the business. Of course, some information will be about the market information, some will be accounting policies, and some will be the business assumptions. And of course, business assumptions will definitely be provided by the client herself. Now, we have compiled together all this information on an Excel sheet, so let me share that with you. And here on this sheet, on the top, we have the header, where we have definitely mentioned the business name and their first year of business and the financial year end. And then we have the market information, the business information, and the assumptions. I have split this information into different sections, but for you that is not necessary. You may simply like to compile all this information into one place on this page. I have split it into different sections to make it more meaningful for you and to make it easier to understand. So first of all, we have macroeconomic information. This information basically relates to the country where we are operating, and our country of operations and sales is USA. Current rate of inflation in the USA is 6%. The current interest rate on small business loan, I mean if we borrow the money from bank, we are going to bear this interest rate, that is 7%. And current interest rate on bank deposits, so if we have money in the bank deposited into the savings account, we will be earning a 3% interest rate on that. And tax rate on small businesses in the USA is 21%. Now there is some information related to the Amazon as well, the marketplace where we are going to sell our goods. So the warehousing, shipping, and the platform fees, that all will be 15%. Basically, this means that Amazon will be managing the warehousing of goods in the USA. They will be shipping it for us as well, and all of that will be costing us 15% of the revenue. And the payment period for us, that will be receivable collection days, will be 14 days. So basically, even if we are selling the goods today, our customers are paying today online, we will be receiving that money from Amazon after 14 days. Now let us talk about some critical key performance indicators. So these are basically the benchmarks that we have agreed, our client has agreed with us for their businesses. And the gross profit margin for the business, which the client has agreed that she will be maintaining, is 75%. The gearing, which is basically debt as a percentage of total capital of the company, the client has agreed to maintain 25% to begin with, but as we are moving year on year, we will not be maintaining that. This is just the gearing level to begin with, but as we are moving forward, we will not be managing the gearing yearly basis, because that is a little bit, too much of work, unnecessary work. And then Inventory turnover period in days will be 20 days, which also means that we will be managing the inventory, holding the inventory of up to 20 days, equal to 20 days of our daily sales. Then the receivables collection period will be 14 days. We already discussed that Amazon pays us in 14 days. And then the payables payment period is going to be 5 days, which means that once the goods have been shipped to us, we will be paying our supplier after 5 days from that. The operational expenses payment days, I mean the marketing expenses and other expenses, we will be paying the suppliers after 10 days of the services, after 10 days of the invoice actually. And the days in the year that we are going to use across this model is 365 days per year. Then the capital structure is 25% debt. We discussed that earlier here. And of course, if 25% is debt, then the remaining 75% will be equity. Now let us talk about the key business assumptions that has been made by the business owner herself. First of all, she has assumed that she is confident that the sales volume in year 1 is going to be 20,000 units, and she is also confident that she will be able to grow the sales volume at 20% per year. So year on year growth is going to be 20. And the selling price that she is going to use in the year 1 is $66. About the cost of sales, the cost per unit in the US dollars is going to cost us is $15, and there will also be shipping fees from China to USA, and that will be 1.5. So the total cost per unit that our business will be bearing is 16.5. About the operational expenses, the administration cost will be 10% of the revenue. So as the revenue grows, the administration cost will also be increasing, and she has assumed that it will be around 10%. The warehousing and shipping will be 15%. We already discussed that, that is coming from the Amazon part. And then advertisement cost as a percentage of revenue will be 25%. And the commission on affiliate sales. So first, let me explain you affiliate sales. So for example, if you Google something like the best birthday presents for kids, you will see there are multiple websites that are recommending you different things. So basically these are affiliates who recommend the products from different suppliers, and then they charge commission if the sales is made with their reference. So if you buy something from my Amazon store, but you basically click the link of my store from their website, I will be paying them a commission for that. So the thing is, commission on affiliate sales here is 25% as a percentage of revenue, of course, and the sales coming from affiliates, out of my total sales that I will be doing, 30% will be coming from the affiliate. So when I am calculating the affiliate commission, I will be using both of these lines together. Then we have capex. Capex is basically capital expenditure. CAP is capital, EX is for expenditure, capital expenditure. So to prepare our very special stuffed toy, we will need to prepare some molds. That is very unique product, so we need some special molds for that. So the initial cost of molds will be $150,000, and that will be our cost. We will bear this cost, and we will then provide these molds to the manufacturer. The life of these molds is going to be 5 years. Similarly, there will be some trade licenses and the product related patents and some other things. We simply call them intangible assets. And these intangible assets will be at the beginning costing us $100,000, and the license terms, the cost of the total life of these intangibles will be 5 years. Then finally we have the depreciation accounting policy, that is straight line basis. Now a straight line basis means that you simply have to divide your life of the real cost of the asset with the life, which means that 150 should be divided by 5 years and split equally over the 5 years. The thing 20% is just a way of further describing that, and 20% simply means if we divide 100 100% of the asset over 5, that becomes 20% each year. So straight line basis 20% is just a way of describing that. The main thing is we are splitting the cost of both the asset, I mean the molds and the intangible asset over the 5 years.